Hi everyone, Assalamu alaikum and good day to all of you, especially to you sir. In this video, we'll dive into lesson 6, which focuses on exchange rates and international capital flows. We'll explore how foreign exchange market works, who participates in them, and why understanding them is essential in today's global economy. So now, let's begin. The foreign exchange market, or forex, is like a giant global marketplace where currencies are bought and sold. Imagine you're a tourist from Japan visiting the Philippines. You'd need to exchange yen for pesos. That transaction happens in the foreign exchange market. But it's not just for travelers. Businesses, governments, and investors all use this market every day, which is why over $6 trillion move through it every single day. So, how do foreign exchange markets work? In the forex market, currencies are traded in pairs like US dollar or euros if you are traveling, investing, or importing goods. You need to exchange currencies. Exchange rates fluctuate based on supply and demand, interest rates, inflation, and geopolitical stability.
If you have ever traveled to a foreign country, you may have needed to exchange your money. If so, you have already participated in forex trading. Forex is the short form of foreign exchange. Well, forex is a bit more than that. For example, companies buy goods from other countries. In order to buy them, they need to obtain the local currency first, just like us when going on holiday. The difference is they will exchange huge amounts. When these companies exchange these huge amounts, they will actually move the price, because the demand for the currency that they need increases. When the demand increases, the price increases. With all this exchanging going on around the world, the exchange rates constantly move. This is how it works. When currencies are exchanged, they have a certain price, the exchange rate. As in any market, the price of a currency is determined by the law of supply and demand. If there are many people or companies that want to change euros into dollars, the price of the dollar will rise against the euro, and so the exchange rate will change. Let's use an everyday example to explain how you can actually profit from this. Say you live in Europe and went on holiday to the United States. Let's say that you changed your 500 euros into US dollars at the rate of $1.4 for every euro. You got 700 US dollars, but you do not spend any money at all. So you still have $700 after you come back. After the exchange rate moved from 1.4 to 1.3, instead of getting just 500 euros back, you actually get 538.5 euros. You have gained 38.5 euros simply from holding your money in dollars while the exchange rate changed. This is essentially how we trade in the forex market. We buy a certain amount of a currency, hold on to it whilst the exchange rate moves, then change it back, making money along the way. How to decide when the right time to buy and sell is exactly what we teach you throughout the rest of our learning lessons. As you can imagine, traveling a lot and saving a bit of money on your holiday budget and then exchanging it, it's not really a practical approach to trading currencies. Fortunately, there is an easier way to do this. You can trade currency through online exchange offices called brokers. What this means is that you can exchange currencies online throughout the day and take advantage of the constantly fluctuating exchange rates. Just as in the example of when you went on holiday, you can buy different currencies and make a profit as the exchange rates change. This is trading the forex market. Trading forex online with a broker has many benefits. You can trade forex from your home or anywhere that you have an internet connection. The forex market never sleeps. It is open 24 hours a day, 5 days a week, and so can suit your daily routine. You do not need a huge budget to get started. As little as $150 is enough to begin trading and building your account over time. Of course, it will require some learning until you get there, but this is exactly what Tradimo is here for. To help you learn how to trade in a way that can suit your individual lifestyle, and to help you navigate your way through the forex market.
Here are some key policies and laws that are directly connected to foreign exchange markets, both internationally and in the Philippines. These policies help regulate how currencies are exchanged and how capital flows across borders. Foreign Exchange Liberation Policy. This policy, issued by Bangko Sentral ng Pilipinas, BSP, allows more freedom for individuals and businesses to buy and sell foreign currency. The connection to it into Forex, it promotes easier access to foreign exchange, making it more efficient for trade and investment. For instance, Filipinos can now open foreign currency accounts or remit money abroad with fewer restrictions. Anti-Money Laundering Act RA 9160. It is a Philippine law that requires financial institutions to monitor and report suspicious foreign exchange transactions. The connection of it to Forex is that it prevents the illegal use of Forex markets to hide or transfer criminal money. For instance, large dollar transfers are reported to the Anti-Money Laundering Council or AMLC. Exchange control regulations. Countries like China and India have regulations that limit how much currency can be exchanged or moved abroad. The connection of it to Forex, these are designed to protect the country's foreign exchange reserves and control inflation or economic risk. Investment laws. The Philippine law encourages foreign investment but also outlines limits in certain sectors. The connection of this to Forex is that when foreign companies invest, they must convert currency. This affects Forex markets and capital flows. Currency Risk Management Guidelines by BSP. Guidelines for banks and businesses to manage risk from fluctuating exchange rates. The connection of it to Forex is that it encourages the use of tools like hedging, helping to stabilize the economy. What is international trade? International trade is the exchange of goods and services between countries. For example, the Philippines imports oil and exports agricultural products. These transactions often require exchanging one currency for another, which links trade to foreign exchange markets. What is capital flows? Capital flows, it is referred to the movement of money for investment purposes across borders. This can include buying stocks, bonds, or businesses in another country. Capital flows are categorized as inflows, money coming into a country, and outflows, money going out. Demanders of currency in the forex market. People or entities who want to buy foreign currency are called demanders. This can include importers, tourists, investors, and governments needing foreign reserves. Suppliers of currency in the foreign exchange market. Suppliers are those offering their local currency in exchange for foreign ones. These include exporters, foreign investors investing in local assets, and people sending money abroad. Foreign Direct Investment or FDI. FDI is when a person or business invests directly in a foreign country. For example, building a factory or buying a company, it usually involves long-term commitment and ownership. Portfolio investment. Unlike FDI, portfolio investment refers to buying stocks or bonds in another country without taking control of the business. It's a more flexible and short-term way to earn returns internationally.
This image shows how investors can make money by guessing how the value of the British pound will change compared to the US dollar. In part A, the investor thinks the British pound will become stronger in the future. So they take 24,000 US dollar and exchange it for British pound at the current rate of 1.50 US dollar per 1 euro. they get 16,000 euro. Later, when the pound becomes stronger and is worth 1.56 US dollar, they change the 16,000 euro back into dollars and get 25,000 US dollar. This gives them a profit of 1,000 US dollar. In part B, the investor thinks the British pound will become weaker. They start with 20,000 euro and change it into 30,000 US dollar at the rate of 1.50 US dollar per 1 euro. Later, when the pound becomes weaker and is only worth 1.40 US dollar, they use the 30,000 US dollar to buy pounds again. Now, they get about 21,429 euro, which is more than the 20,000 euro they started with. So, they make a profit of 1,429 euro. In both cases, the investor makes money by buying and selling currency based on how the exchange rate changes.
Hedge. A hedge is a financial strategy used to reduce risk. For example, a company expecting payments in euros might hedge by locking in a favorable exchange rate now to protect against future currency changes. So to recap, the foreign exchange market is where currencies are traded, international trade and capital flows connect economies, and participants in the market include both demanders and suppliers of currency. Investments like FDI and portfolio investments drive global financial ties, while hedging helps manage currency risks.
So let's proceed on our next topic, which is the participants in exchange rate market. But first, let me define what is an exchange rate. So exchange rate is the price of one country's currency in terms of another currency. In other words, it tells you how much of one currency you need to buy a unit of another. For instance, if 1 US dollar is equal to 1.36 Canadian dollars, then the exchange rate is 1 USD is equal to 1.3 Canadian dollars. Or for here in the Philippines, the value of US dollar is 57 pesos. 57 pesos is equal to $1, so the exchange rate is 1 USD is equal to 57 pesos. So, exchange rate, it plays a crucial role in global trade and finance. They affect the cost of imports and exports, influence tourism, and impact international investment decisions. So the participants in exchange market rates is first, we have those tourists and consumers. So these are the everyday individuals who need to convert their local currency into foreign currency when they travel or shop abroad. For instance, me, if I travel to Japan, I must exchange our Philippine peso to yen for me to pay meals, transportation, and go to shopping or to buy souvenirs. Moving on to the firms. So, these are the importers and exporters. So, those businesses that buy and sell goods and services across countries must convert their currencies to complete the transactions. For instance, a Filipino company importing cars from Germany needs to convert pesos into euros to pay the German supplier. Moving on to the banks. So, banks act as intermediaries offering currency exchange services to the public and businesses. So, they also offer trade large volume of currency in global financial markets. So, for example, here in the Philippines, the BDO helps an overseas worker to convert their US dollar remittance into Philippine pesos for their family. Next is those foreign exchange dealers. So these are the specialized banks or institutions that deal in large amounts of currency trading, mostly with each other in the interbank market. They also help maintain the liquidity of the forex system. For instance, as a forex dealer at Citibanks handles daily transactions worth millions of dollars in different currencies to balance international accounts. So next is those portfolio investors. So these are the investors who move money from one country to another to earn short financial gains. So these investors closely watch exchange rates to maximize profits. For example, a US investor buys shares in Philippine company. So if the peso strengthened later, the investors gains both from stocks depression and currency value. Moving on to those multinational corporation or the MNCs. So these are the large companies that operate in many countries. They deal with foreign exchange regularly for business operation, investments, and financial planning. For example, is the Coca-Cola. So Coca-Cola sells drinks worldwide. So they convert local earnings, for example, in pesos or yen into US dollars to report their profits. Moving on to brokers. So these brokers act as middlemen by matching buyers and sellers in foreign exchange markets. So they don't usually hold currency, but they earn by facilitating those trades. For example, a forex broker helps a business in India to convert a large sum of rupees into euros for importing equipments. So, strengthening currency or the appreciation. So, a currency is said to appreciate when its value rises compared to the another currency. This means that you can get more of a foreign currency in exchange for the same amount of your local currency. For example, yesterday, 1 US dollar is equal to 1.10 Canadian dollar. But today, 1 US dollar is equal to 120 Canadian dollar. So this means that the US dollar has appreciated against the Canadian dollar. Now, each US dollar can buy more Canadian dollars. So this is good for American travelers going to Canada and for American importers buying Canadian goods as their money goes further. Moving on weakening currency or depreciation. So a currency depreciates when its value falls in relation to another currency. This means that you can get less foreign currency for the same amount of local currency or local money. For instance, last week, 1 US dollar is equal to 1.20 Canadian dollars. But today, 1 US dollar is equal to 1.05 Canadian dollars. This means that the US dollars has depreciated. Now, $1 buys fewer Canadian dollars than before. This is bad for US tourists visiting Canada. Everything becomes more expensive, but good for those Canadian exporters because their goods become cheaper for those Americans to buy. So how exchange rate movement affect different groups?
When the value of a currency changes, it doesn't affect everyone in the same way. Some people benefit while others are hurt, depending on their role in the economy and the direction of the exchange rate movement.
So, first is we have the US exporters. So, when the US dollar appreciates, exporters find their products become more expensive for foreign buyers, reducing international demand. For example, a US car manufacturer trying to sell vehicles in Canada may faces a drop in sales because the cars cost significantly more in Canadian dollars. Moving on to those foreign exporters to the US. So a stronger US dollar means foreign exporter earn more money or earn more their home currency when converting back to dollars. For instance, a Japanese electronic company sells TV in the US. So when the dollar is strong, converting these dollars back to yen yields higher profits. Moving on to the US tourists abroad. So when the US dollar is strong, travelers find that it converts into more foreign currency, reducing their overall travel expenses. For example, a family vacationing in South Africa benefits because the strong dollar means they get more rands for each dollar, lowering hotel and dining costs. Moving on to those foreign tourists in the US. So, conversely, a strong US dollars makes travel in the US more expensive for visitors from another countries. So, for instance, a British tourist visiting New York will find that their pounds convert into fewer dollars, making shopping and dining more costly. Next is those US investors abroad. So investors who place money in foreign assets may see their returns diminish when converting back into dollars if the dollars is so strong. For example, an American investing into a European mutual fund might face lower overall profits when the strong dollars reduces the value of earning in euros. So, moving on to the foreign investors in the US. So, a strong US dollar can be beneficial for the foreign investors because upon reconversion, they receive more of their home currency. For example, a German investor in UH stocks will see their returns amplified when converting profits back to euros thanks to the stronger dollars. To sum up, exchange rates are not just abstract numbers. They directly influence the cost of goods, travel, experiences, corporate profits, and investment returns around the world. Whether a currency is appreciating or depreciating, different sectors of the company experiences the impact in unique ways. Thank you for watching.